Stop what you're doing. Turn off that television. Tell your spouse the chores can wait. If nature calls, take your device with you and secure that bathroom door. Because what I'm about to expose regarding the institutional chaos erupting across Wall Street trading desks at this very moment is so time-sensitive that everything else just became irrelevant. We need to discuss these phone calls, and I need your undivided attention for the next 10 minutes. Over the past 48 hours, my email has been exploding. I'm receiving communications from private wealth managers, from ultra-high net worth players in London and Manhattan, and even from everyday retail investors holding substantial positions in their trading accounts. And the narrative is identical across every single message. They're reporting that their brokers are initiating contact unprompted. Now, if you've been around these markets for any length of time, you understand that brokers typically only reach out for two specific reasons: to push a commission-heavy instrument you don't require, or to hit you with a margin call when your account is underwater. They don't contact you to hand out complimentary winning strategies. Yet suddenly this week the telephone lines are on fire. Ladies and gentlemen, Asian guy here, known as John A.G. from Currency Archive. We're catching specific institutional names circulating through the rumor channels. And the messaging they're delivering is word for word identical. It's synchronized. It's calculated. They're contacting clients who've maintained silver positions through the challenging periods. Clients who accumulated at $20, who persisted through $30, and who are currently holding enormous profits at $80. And they're declaring the rally is finished. You must exit immediately. But they're not simply suggesting profit taking. That would be standard procedure. They're pushing further. They're aggressively proposing that risk-tolerant clients should consider establishing short positions. They're promoting put options. They're advocating inverse ETFs. They're instructing their own clients to wager against the most powerful bull market in a generation. And the terminology they're employing, it's engineered to create terror. They're not projecting a modest pullback. They're deploying words like catastrophe. They're using expressions like structural liquidity crisis. They're warning grandmothers and pensioners that a devastating, unavoidable collapse is guaranteed to strike the silver market within the next 72 hours, and that unless they liquidate everything immediately, they're going to awaken financially ruined. They're constructing an image of a catastrophic plunge that will eliminate all the profits of 2,025 inches a single trading session. Now, I want you to freeze for a moment. Distance yourself from the anxiety. Take a deep breath and approach this like an investigator. Pose the most crucial question in finance. Cui bono? Who profits? Since when do the major bullion banks prioritize your financial prosperity? Since when do they proactively contact you to assist you in timing the precise peak of a market so you can optimize your returns? They didn't reach out when silver was at $18 and inform you it was the acquisition opportunity of the decade. They remained silent. In reality, they were publishing analyses claiming it would decline to $15. They didn't call you when it shattered $50. But now that silver is at $80 and accelerating higher, now that the COMEX is being depleted and the Shanghai differential is expanding explosively, suddenly they've become your closest allies. Suddenly they're profoundly worried about your downside risk exposure. Absolutely not. This is an ambush. They're not calling to protect you. They're calling to protect themselves. They're frantically attempting to manufacture sellers because they're desperate for liquidity. You must recognize that for every seller there must be a buyer. If they're instructing everyone to liquidate, who is preparing to acquire? They are. They're attempting to engineer a cascade of retail panic selling to supply the liquidity they require to close their own catastrophic short positions. They're trapped in a burning structure and they're attempting to persuade you to rush into the flames so they can use your body to extinguish the fire. They're likely short 4.4 billion ounces of a metal that is vanishing from the warehouses. Every single dollar the price advances costs them billions in margin requirements. They're hemorrhaging capital, and the only method they can halt the bleeding is to manipulate you into surrendering your position. They need you to liquidate your winning lottery ticket for pennies on the dollar so they can cover their shorts before the genuine explosion occurs. And the weapon they've selected for this psychological warfare, the boogeyman they're deploying to frighten you out of your position, is a technical bureaucratic occurrence that most individuals have never even encountered. They're highlighting a scheduled event designated the BCI Rebalancing. They're presenting this rebalancing event like a loaded weapon, asserting it will trigger a $6 billion liquidation that the market simply cannot accommodate. They're informing you that this is the catalyst that terminates the bull run. But is it? Is this genuinely a catastrophe, or is it the most sophisticated bear trap we've witnessed in decades? To comprehend the deception, you first must understand the fragment of truth they're concealing it within, because the BCCI is legitimate, but the narrative is a complete fabrication. To dismantle this deception, we must begin by examining the weapon they're wielding. We must understand the specific mechanism they're utilizing to terrorize the market, because it's not a fictional story. It's a genuine structural component in the global financial apparatus. We need to discuss the Bloomberg Commodity Index, or the BCCI. Now, to the typical person, this sounds like tedious financial terminology. It sounds like just another ticker symbol streaming across the bottom of CNBC. But to the institutional money, to the sovereign wealth funds in Norway, the pension funds in California, and the university endowments at Harvard and Yale, the BCCI is not merely an index. It's the scripture. It's the grandfather of all commodity investment instruments. It's a colossal, passive, algorithmic entity that controls roughly $108 billion in assets. Consider the magnitude of that figure, $108 billion. This is capital that doesn't think. It doesn't evaluate charts. It doesn't monitor the news. It doesn't concern itself with supply deficits in Mexico or solar panel consumption in China. It's blind capital. It simply follows a basket of commodities according to a strict set of protocols written by mathematicians in New York. And because it's a passive machine, it adheres to a rigid schedule. It doesn't wake up one day and decide to liquidate silver because it feels pessimistic. It only executes when its programming dictates it to execute. And the most critical instruction in its entire algorithm is the January rebalance. Every year in the initial weeks of January, this $108 billion machine has to perform a maintenance procedure. It has to examine its portfolio, which contains everything from crude oil to soybeans to coffee to gold to silver, and it has to modify the allocations of every single component of the basket. It has to ensure that the quantity of capital it holds in each commodity corresponds to the target allocations that were established for the new year. It's a purely mechanical operation. It's automatic. It's unavoidable. And this is the fact, the undeniable bureaucratic fact, that the brokers are screaming about on the telephone. They're screaming because the targets have shifted. For the year 2026, the governing committee of the index has mandated that silver's target allocation must be reduced. They've decided to decrease the exposure. Technically speaking, the target allocation for silver is declining from roughly 4.49%, which was the target for last year, down to a new target of roughly 3.94%. On the surface, this appears like a straightforward sell instruction. The brokers are pointing at this documentation and shouting, "Look, the robot is programmed to sell. The biggest whale in the commodity market is dumping its holdings. You must sell before the robot does." They're characterizing this as a vote of no confidence in silver. They're characterizing it as a fundamental rejection of the metal, but that's the deception. The robot isn't selling because silver is problematic. The robot is selling because silver was too successful. The index has regulations. It has limitations. It's not permitted to allow any single commodity become too dominant. And because silver performed so extraordinarily well in 2025, because it outperformed nearly every other asset on Earth, it expanded too large for the basket. It began consuming too much space. So the regulations state it must be trimmed. It must be pruned back to proportions. It's the penalty of excellence. But the brokers aren't disclosing that. They're informing you that a catastrophe is approaching. They're telling you that this mechanical adjustment is going to trigger a cascade of liquidation that will shatter the backbone of the bull market. They're utilizing this dry administrative rule modification as a psychological weapon to induce panic. And to make the fear penetrate, they're broadcasting massive dollar amounts. They're suggesting that because the fund is so enormous, $108 billion, even a tiny adjustment in the percentage points, translates into a mountain of capital. They're claiming if this massive fund begins dumping, who is going to catch the falling knife? It will obliterate the bid stack. It will annihilate the order book. This is the narrative they've constructed. It's built on a foundation of truth. The rebalance is legitimate. The selling is mandatory. But the conclusion they're drawing that this equals a crash is a deception built on flawed mathematics. And this is where we catch them red-handed, because if you actually sit down and perform the calculations, if you actually examine the figures they're attempting to conceal from you, you realize that the scale of the selling isn't just significant. It's actually much, much larger than the dismissive crowd believes, but it's also completely misunderstood. There's a specific mathematical error circulating around social media right now. You might have encountered it on Twitter or Reddit. People are claiming, oh, the target is only declining from 4.5 to 3.9. That's a difference of 0.5%. That's insignificant. It's only $600 million. Why is everyone panicking? And the brokers love this. They love you're confused. Because The people claiming it's only $600 million are incorrect. And the brokers asserting it's a catastrophe are misrepresenting the impact. We need to clear the fog of war. We need to perform the genuine math right now together on the screen. We need to calculate precisely how many ounces are about to hit the market, because the figure is not $600 million, it's 10 times that magnitude. And once you see the genuine number, you'll understand why the banks are so desperate to get you to liquidate. Let's examine the real mathematics. Let's examine the $6 billion reality. You cannot simply examine the target from last year and subtract the target for this year and believe you've solved the puzzle. That's amateur math. That's elementary subtraction. And in the brutal world of high-frequency commodities trading, that kind of lazy thinking gets you slaughtered. The people on social media who are informing you, relax, it's only a 0.5% adjustment, are missing the most critical variable in the entire equation. They're forgetting about price action. They're forgetting what silver actually accomplished in 2025. Consider it. When the year commenced, silver was sitting quietly in the basket, occupying its assigned slice of the pie. But then the rally initiated. Silver didn't just increase a little bit, it exploded. It went from $30 to $40, then to $60, then to $80, and more than doubled in value in a single calendar year. Now imagine you have a pie chart of assets. If one slice of that pie doubles in magnitude while the other slices like oil and corn and wheat remain relatively flat or decline, what happens to the pie? The winning slice expands, it takes over. It begins pushing everything else off the plate. By the time we reached December 2025, silver wasn't occupying 4.5% of the BCCI fund anymore. It had swollen like a balloon. The effective weighting of silver in the fund had ballooned to nearly 9% of the total assets under management. So when the rebalancing robot activates in January, it doesn't just examine the old target. It examines the current reality. It observes that silver is currently hogging 9% of the room, but the rulebook states it's only permitted to have 3.94%. Calculate the math on that differential. The robot doesn't have to sell 0.5%. It has to sell the difference between 9% and 3.94%. It has to dump roughly 5% of the entire $108 billion fund. It has to amputate half of its silver position to get back in compliance with the regulations. Now, let's put a dollar sign on that because this is the figure that the brokers are whispering to terrify their clients. Take $108 billion. Calculate 5% of that. You're examining a sell order of roughly $5.4 billion to $6 billion. $6 billion. That's not insignificant. That's a Leviathan. If you convert that into paper contracts at current prices, you're discussing roughly 70 to 78 million ounces of silver that need to be expelled by this index in a very compressed window of time. That's almost 10% of the entire annual global mining production being sold in a matter of days. This is why the brokers sound so confident on the telephone. They aren't misrepresenting the volume. They have the spreadsheet right in front of them. They observe this $6 billion wave crashing into the order book, and they're informing you, look, it's mathematical suicide to stand in front of this train. You must short it. They're utilizing this massive, undeniable number to convince you that the price must collapse. They're wagering that the market structure is too fragile to handle a 70 million ounce liquidation. And if you only examine this one number, if you only examine the sell side of the ledger, you would agree with them. You would panic. You would sell. But this is where the trap closes. Because in financial markets, volume is not synonymous with impact. Just because someone has to sell $6 billion worth of assets doesn't mean the price has to crash today. Depends on when they sell it, and it depends on who knows they're going to sell it. And this is the secret that JP Morgan and Morgan Stanley are concealing from you. They're pretending that this $6 billion sell order is a surprise. They're pretending that it's hitting the market right now, this week, all at once. But is it? Does a fund manager with $108 billion wait until the final minute to execute the biggest trade of the year, or do they play a different game? We need to expose the timeline. We need to examine the concept of front running. We need to explain why this crash is already in the rearview mirror. You have to pose a very simple question about market mechanics. If you knew with 100% mathematical certainty that a massive whale was going to liquidate a huge amount of silver in January, would you wait until January to react? If you were a shark at Goldman Sachs or a hedge fund manager at Citadel, and you saw the BCCI announcement back in October 2025, would you sit on your hands for 3 months? Would you wait for the price to potentially decline before you exited your position? Absolutely not. In the professional trading world, waiting is synonymous with losing. The moment that report was published in October, the moment the target allocation was reduced to 3.94%, the smart money began moving. They began front-running the trade. This is the dirty little secret of the index game. The BCCI is not a surprise party. It's the most telegraphed punch in financial history. Everyone knows it's approaching. Everyone knows the magnitude. Everyone knows the date. So the active managers, the guys who run the funds that track the index but have the freedom to trade around it, they didn't wait for this week. They spent November selling into strength. They spent December selling into the rally. They slowly, methodically offloaded that $6 billion of exposure while the price was ripping higher. They utilized the liquidity of the bull market to conceal their exit. They were feeding the ducks while the ducks were quacking. So by the time we actually reach January 8th, 2026, by the time the brokers are calling you on the phone screaming catastrophe, the vast majority of that selling pressure has already occurred. It's already been absorbed. The reason silver didn't reach $100 in December, the reason it paused and consolidated around $80 was precisely because this selling was taking place in the background. The market has already consumed the $6 billion meal. It's digesting it right now. What remains for this week? What remains for the so-called crash? Only the passive capital. Only the strict passive ETFs, like the iShares Commodity Trust or the DJP fund. These are the funds that are legally prohibited from trading early. They must trade on their rebalance date. But these funds are minuscule compared to the whole. They represent maybe 2 billion or 3 billion of the total. They're the tail of the dog, not the dog itself. And this reveals the true nature of the broker's call. If JP Morgan knows that the smart money liquidated in December, and they know that only the passive robots are selling today, why are they instructing you to short now? Because they want you to sell the bottom. They want you to examine the selling from the passive robots, which might push the price down $1 or $2 for a few hours and mistake it for the beginning of the end. They want you to panic dump your shares into a market that is already priced in the event. They're attempting to get you to provide liquidity to the very same active managers who are now looking to buy back in. Consider the cycle. The active managers liquidated in December at $85. Now the passive robots sell at $75. The active managers are sitting there with cash, waiting to acquire those discounted shares back from the robots and from you to ride the next leg up. The brokers are assisting them close the loop. They're recruiting you to be the victim in a game of musical chairs that ended 10 minutes ago. This is why I call it a hoax. The volume is legitimate. Yes, $6 billion was sold, but the timing is the deception, and the impact is in the past, not the future. We're examining a rear-view mirror event. And while the West is obsessing over this paper shuffle, while New York traders are sweating over basis points and rebalancing dates, there's a force in the East that couldn't care less about the Bloomberg Commodity Index. There's a buyer who doesn't use algorithms, there's a buyer who uses ships. And this buyer is examining this dip not as a panic event, but as a clearance sale. We need to pivot to the bullish reality. We need to discuss the China shield. We need to explain why every single ounce that the BCCI robots expel onto the market is being instantly swallowed by a dragon. Let's examine the arbitrage. Let's examine why the dump is destined to fail. And this is where the bank's plan falls apart completely. This is where their sophisticated paper game crashes headfirst into the brick wall of physical reality. Because while the algorithms in New York are obsessing over target allocations and rebalancing dates, there's a monster in the East that is consuming everything in sight. We have to discuss the China shield. We have to discuss the single most important figure in the global silver market right now, which is not the price you see on your screen. It's the difference between the price on your screen and the price in Shanghai. Right now, as we speak, the Shanghai Gold Exchange, the physical hub where metal actually changes hands in China, is trading at a massive premium over the COMEX in New York. We're witnessing a spread of nearly $7 an ounce. Do you comprehend the physics of what that signifies? It means that a bar of silver is worth $7 more the moment it crosses the Pacific Ocean. It's an arbitrageur's dream. It's free money. If you can acquire silver in New York for $75 and liquidate it in Shanghai for $82, you don't just do it once, you do it 1,000,000 times. You do it until the vault is empty. Now, consider what the BCCI rebalancing actually accomplishes in this environment. The robot comes in and dumps $6 billion of paper onto the New York market. This temporary selling pressure pushes the COMEX price down. Let's say they manage to push it down from $80 to $72. The brokers cheer. The shorts celebrate. They believe they've won. But what have they actually accomplished? They haven't destroyed demand. They've just put the metal on sale. By pushing the New York price down while the Shanghai price stays elevated, they've just widened the arbitrage spread from $7 to $15. They've just turned a profitable trade into the trade of the century. They've effectively subsidized the Chinese accumulation of silver. Every single time the price dips in New York, the vacuum cleaner in the East turns on full blast. The arbitrage traders, the global banks, the commodity houses, the Chinese state-owned enterprises, they examine that $72 price tag and they scream buy. They scoop up every ounce that the BCCI robot sells. They take delivery, they load it onto ships, and they send it to China. The dump that the brokers are warning you about is actually a gift to Beijing. It accelerates the drain. It speeds up the very shortage that drives the price higher in the long run. The BCCI is literally transferring wealth from Western pension funds who are forced to sell low to the Chinese government who's happy to acquire low. And why is China buying so aggressively? Why is there a physical floor under the market that refuses to break? Because China isn't trading for a quarterly bonus, they're trading for survival. They control 80% of the global solar panel manufacturing capacity. They know that without silver, they cannot build the solar panels. Without solar panels, they cannot achieve energy independence. They're examining the same geological maps we are. They observe the mine supply shrinking. So when they see a rebalancing event, when they see the foolish Westerners selling silver because a rule book instructed them to, they don't panic. They laugh, and then they buy. This is the China Shield. It's a massive, impenetrable wall of buy orders sitting just below the current price. It ensures that any dip caused by this rebalancing will be shallow and it will be short-lived. You cannot crash a market when the biggest buyer in the world is standing there with an open checkbook praying for a discount. So, if you listen to your broker, if you short the market right now, you're not wagering against a bubble. You're stepping in front of a freight train called the People's Republic of China. You're wagering that a paper algorithm in New York is more powerful than the industrial demand of the world's second largest economy. That's a suicide bet. The banks know this. JP Morgan knows the spread exists. They're probably the ones trading it. But they need you to be the liquidity on the other side. They need you to be the fool who sells your physical or your ETF shares so they can cover their shorts before the inevitable snapback occurs. They're utilizing the rebalancing narrative as a smokescreen to conceal the fact that they're terrified of the East. They know that once this $6 billion selling window closes, there's no more inventory coming. The passive funds will be empty, but the Chinese demand will still be there. And that's when the real fireworks begin. That's when the price stops reacting to New York and starts reacting to Shanghai. So, we've exposed the broker hoax, we've debunked the math, we've revealed the front running, and we've identified the buyer of last resort. What's the final verdict? What should you do when that phone rings? We need to wrap this up with the conclusion. We need to give you the final marching orders for this week. Let's finish this exposure. Let's tell the banks precisely where they can shove their catastrophe. You have to remember the single most important statistic in this entire saga, the figure that keeps the risk managers at JP Morgan awake at night sweating through their sheets. They're short 4.4 billion ounces of silver. They sold promises they cannot keep. They sold metal they do not possess. And now with the price ripping through $80 and inventories disappearing, they're staring into the abyss of a default. They need a miracle. And the BCCI rebalancing is the only miracle they have left. It's the only scheduled event on the calendar that guarantees a wave of selling pressure. It's their one and only chance to create a smokescreen. They're utilizing this event to generate enough noise, enough fear, and enough confusion to cover their tracks while they attempt to exit their positions. They're hoping that if they scream catastrophe loud enough, you will panic. They're hoping that you'll examine a red candle on a chart, triggered by a mindless robot in New York, and mistake it for the end of the world. They need you to be the liquidity. They need your shares. They need your contracts. They need your physical bars. Because if you don't sell to them, they have to acquire from China at $90 or $100. They're begging you for a bailout. So, here's my final instruction to you for the week of January 8th, 2026. When that phone rings and you see the name of your brokerage firm on the caller ID, when they begin reading from that script about downside protection and rebalancing risks, hang up. Do not engage, do not debate, and certainly do not sell. Do not let them talk you out of the only asset that's effectively immune to the debt collapse of the Western world. Do not trade your sovereign wealth for their dying paper promises. You must have the discipline to look past the next 48 hours. The rebalancing window is closing. The robot is almost done selling. The uninformed money is almost done panicking. And once that selling pressure lifts, which is a matter of days, not weeks, the weight is gone. The beach ball is released. The price will not just recover. It will snap back with a violence that will shock the shorts. We're examining a slingshot maneuver that takes us straight through $85 and opens the road to triple digits. The fundamental drivers haven't changed. The mines are still empty. The solar panels are still being built. The dollar is still dying. The only thing that changed was a line of code in a Bloomberg index. And that line of code is irrelevant to the laws of supply and demand. This is a game of chicken. The banks are revving their engines, flashing their lights, and driving straight at you, hoping you will flinch. But their car is made of paper, and your tank is made of silver. If you hold the line, they crash. If you hold the line, the 4.4 billion ounce short position blows up. This is not just a trade anymore. It's a transfer of wealth. It's the wealth of the manipulators flowing into the hands of the stubborn. Be stubborn. Be the immovable object. Do not be the victim of the catastrophe hoax. Be the beneficiary of the rebalancing sale. If they push the price down to $75, thank them and then acquire more. Because in 6 months when we're trading at $150, you won't remember the BCCI. You'll only remember that you didn't let them steal your future. This is John A.G. The hoax is dead. The target is locked. Remember to like, subscribe, and share. See you on the other side.